Thank you for coming. I'm happy to see we are a full room today, and I see many people that they are coming for the first time. So, for how long have you been investing? From 0 to 5 years. Just raise your hands. Don't be shy. Yeah. Okay. 0 to 5. Yeah. 5 to 10. Okay. 10 to 20. Okay. 1, 2. More than 20. Only one. Wow. You're the chief. Okay. I just see something on the screen, so I have to remove it. Sorry. So, for those that you're coming for the first time, we are the London Value Investing Club. And we also operate in multiple cities, but the most the most active one is here in London and then in Malta. Just let me tell you that we are all free to express our opinions, our thoughts, but whatever we say, it's don't tell it as an advice. It's just a discussion. So that's a disclaimer. On our website, cityfalcon.ai/meetup, you can find the past presentations. It's always interesting to go, and the further back you go, the more interesting it becomes, because people always, we think in different ways every time because of the current climate or the current situation. And it's always good to go 2-3 years ago and see how we think of things, and the presentations, of course. So you can go to cityfalcon.ai/meetup, where you can also find the performance of the ideas that were presented here. This green, you see some green numbers, some great performances when Rusbe, like more than a year ago, presented about AI when ChatGPT was hot, and these talks have done really well. So you say that you are interested. We have also a WhatsApp group now running. So whoever is not part of the WhatsApp group, they can talk to me at the end and I can add them. And you say that you are interested in one of the things that you want us to discuss is the geopolitical tensions. This is again from our site, and you can see like some key headlines over the past month. And you see in these geopolitical events basically Russia and China and maybe Middle East. So out of all those, which one is the one that scares you the most? Yeah, you can.
No. I'm just asking for a vote.
I mean, you can say your opinion. You can say your opinion. What scares you the most? What you find the most? The one that worries you, like something happens with Russia, the US-China tensions, a flare-up in the Middle East.
Yeah, I find for me personally, China is the worst. Like Middle East, it's pretty well contained, even though there's going on a war there. There's like a war between like very two small countries. It doesn't seem like it's going to have spillovers into the oil, which is important. Russia seems to be like phasing off as well. There are like some peace talks against on Ukraine and Russia, and perhaps with Donald Trump winning in the U.S., Putin is gonna be like more, hey, let me just go back. Maybe they take a piece of Ukraine and like, let's call it a day. But China is still interesting because there will be probably a shift in the superpower, right? Of this country where China is going to take over as like the biggest exporter of everything, importer of everything. That scares me a little bit because I don't know much about how they're going to behave with other countries and everything else. That's my opinion.
Other thoughts? Other thoughts? Anyone on geopolitics? Like, okay, I can tell you like that personally. I worry more about the U.S.-China. Of course, I mean with Russia, something that happened there, and it can lead like to like a war situation. But I think that China and US are drifting apart, and I don't know if that is fixable. And it worries me a lot also about Taiwan. Who knows?
I will also add to that, right? Because I think one of the big things about being an investor is not what exactly is happening right now, but what might happen. And like, are you thinking that Russia is going to invade, I don't know, Slovakia or like Poland or things like that? I think that's a very long shot. Same thing goes in the Middle East, but like China and Taiwan, like that's a very real possibility that I don't know that's a very slippery slope essentially, right?
But feel free to talk. Like I want to keep this as a discussion. So if any of the newcomers you have any thoughts about it, just feel free. Just feel free to say your opinions about it. Yeah.
I would like to say that by studying people like Warren Buffett, Charlie Munger, etc., my understanding is that we should focus more on businesses instead of events, geopolitical and microeconomic events, because we cannot control them, and over the long term, nobody knows. But if you focus on a specific business and how it performs, it's better to make decisions based on that, based on microeconomics instead of macroeconomics. Yeah.
I agree with you, but personally, let's say I would avoid China because of this. So I wouldn't, let's say, count geopolitics just to avoid investing, not trying to getting in and out of investing because there's something happening.
Yeah.
But I might let's say avoid Chinese companies because if you know that, let's say, it will be some split between the West and East, probably it's not safe to be there. But yeah, I agree with you that we should have like as you say, like I agree with your. Any other thoughts?
One more thing. In general, I would say I think, but at the same time I'm biased because people like Mark said the same thing. So I'm not sure if it's 100% original thought. But if the whole world will progress in the next decades, if there is no nuclear attack or event, that will change the civilization. It will bring us centuries back. If that doesn't happen, then because of global trade, etc., the civilization will progress and the economy as well. Not absence of this.
And also due to AI, probably, where we will talk about later.
It's positive, the whole thing, given that we will not have a nuclear event. I was going to say...
The microphone close.
Yeah, it's working. I was going to say the conclusion really is just to worry macro but invest micro. And I definitely agree with you just to stay away from certain countries due to geopolitical risk, etc. But I think as long as you worry macro, but you invest micro, and you're able to build those mental filters and understand business models, I think you're probably better off, as you say, the greats, Munger and Buffett.
Okay. So now, if we have to vote among these three like I would say that probably we agree that one is the Middle East, the other one is like US, China, China, Taiwan, like China, and the other is the Russia, Ukraine. Between those three, if we have these three options, do you want to add a fourth option? Okay.
Which one?
Completely different. Actually, not geopolitics, but I think there's more of a social conflict at the moment where there's been enormous cost pressures and there's certain strata of societies across the West and globally that will there's a big spending gap, and I think that's something we need to be a bit more sort of conscious of as investors. For instance, I think tech companies could be more of tax targets like oil companies used to be, perhaps.
Yeah, that's totally fair. Probably it's not related to geopolitics, but it's a valid concern. But if we have to vote about those three, let's say the geopolitics one, and I will just ask you to raise hands. Who is more concerned about China? Let's say we name it like China, US, or Taiwan. Okay. Then Russia, Ukraine. Okay, less. And then Middle East, which could have more on the energy prices, probably more effect. Yeah. Okay. So let's move from geopolitics to politics. Here, I want us to be careful. I don't want to be very political, and I will add to what you said before that I prefer to see things from the micro level. So I'll give you an example. I have been owning some home builders, and let's say the fact that the Labour government is planning to build, that's what they are planning to do, 1.5 million homes, that is something that can affect home builders. So again, you can go to the micro level, or later David will present a company that imports from Colombia, right? So if Trump, let's say, is elected, that will affect. So we can always think of these little things. So do you have to comment anything on here? Like if you think that something will shift, like on energy, or if you see any opportunities according to your beliefs. And I don't want us to be political, but we can talk as investors about it. Yeah. So I will pass the microphone to you.
So personally, I'm a bit concerned about escalating debt levels, especially in the West. I don't think politicians will reduce the debt. I think we'll just keep printing money, and that's going to cause inflation. And the rich are going to get richer because they have the assets, and the poor are going to get poorer. And that's going to create this inequality and this tension within society, which could have some sort of impact in the future. So that's something I'm concerned about. That's more long-term perspective.
Other opinions that relates to your investments. Let's say think of your investments and think of something that is happening in the UK, in the US, or even France. I don't know if we have French people and the situation there. Yeah, it's becoming messy and the political system is different. Do you want to say a few things about also France? I don't have it here, but it's an interesting one because it might affect the European Union.
So, 5 words. It's a complete mess, but it's a big opportunity. So, last time I presented LVMH. LVMH dropped 8% after the French elections, knowing that probably 80 or 85% of the revenue is outside France. So I see all of this as opportunities, to be honest. If there is chaos, there's blood on the street, and you can buy cheap stuff.
I mean, that's a good comment, because sometimes when something happens, it's not always from the business side, because as value investors, we look at value and price, and sometimes what changes is the value, and the opportunities are because of value. We see all these developments and we see that value changes, but sometimes maybe the long-term value of our companies doesn't change, and what changes is the price and creates opportunity. Something that I hadn't thought, and thank you for reminding us. Any other thoughts? If you think anything about the UK or the US, or how it could affect specific sectors, think of your investments, for example. And if you don't have anything to add, we can move on. Okay.
I think for me, with the UK, I think we're overlooking sentiment, which is always a really important thing for me. The fact that we have a new government, whether we agree with their policies or not, may mean that the overall sentiment within the country leads to some improvement in the markets, and that's what we're looking for if we want to, in one way, profit from our investments. The way, obviously, is to have a company that goes up in value by increasing profits, retaining those profits, and reinvesting them very well. But in the shorter term, another thing we can look at is how do British people feel about the fact that there's a new government? How does the rest of the world feel about the fact that there's a new government and the investment opportunity here? So I think it's going to be a positive. I think there's a lot of people looking at the UK at the moment and realising that a lot of companies are very cheap. You can look on a large scale and look at the disparity of companies like Shell versus their US peers, and how they're already saying we're very undervalued in the market by virtue of being a British company. So the choice is either relist or take the pain short term, and I think if you've got new UK companies, I think it's a great, if you're finding value in the UK, it's probably a great thing.
And also to add here, and also, what happened to my phone? Ran out of battery. Maybe, 1, 2, I'll use another one, it's fine. 1. One, two, oh, yeah, that works. Okay, so what I want to add here is probably also the European Union might see the new governance less a target to get revenge or something, because now let's say they want to avoid like other members to get out without consequences. So maybe those that they were more pro-European, they might be less strict with them, probably. So maybe the UK-EU, I don't know, trade relations might improve a bit, because these were not the people that they were, you know, the Brexit camp. But anyways, let's see how it can evolve. But yeah, these are good thoughts. Any other thoughts? Yeah?
Yeah, I really think US elections, as an example, will create a lot of volatility, both like months before election and right after election, and first months of the new president. And I think, like, funny thing is that there is uncertainty both in terms of who will be the president, but like even more uncertainty what will be done, but even more uncertainty how perception of the markets will change. For example, when it was Trump versus Clinton, markets thought it will be Clinton, and they thought that Trump will be terrible for American economy, so it turned out that it's Trump and it's not so terrible. So I just think we really can expect a lot of volatility, and really it's like, on the one hand it's highly predictable. We have only 2 outcomes, like 2 candidates, but at the same time it's unpredictable what they will do, and how it will really affect markets and sectors. Yeah.
Okay, back to Alex, and Alex talked before, but yes, we can go to Alex and then we'll go to you, and then we'll continue.
Just kind of reinforcing on that point of volatility, it's rather uncertain world. And I think that in a diversified portfolio, everyone should have some precious metals, gold, silver. I think it's more important today than it has been in the past.
Gold as a commodity, or
Gold
companies?
maybe gold mining companies, if you have the ability to analyse them. I personally don't. So I might just buy the commodity. But if you have the ability to analyze an eye, and that might be
You can take it.
You can take it.
You're very far. Okay, okay. Thanks, Alex.
Yes. Yeah, so I would like to add something to what this gentleman said earlier about the inflation. I don't think politics matter long term unless you get to a situation where inflation gets out of control and you have like a crazy megalomaniac who will take control of the country, like what happened in Germany in the 30s. Inflation was a main driver that led to the situation, so it can be very, very dangerous. If we don't have inflation, I don't think politics matter too much long term.
Yeah, okay.
There are some fluctuations, some of them will raise taxes, lower taxes, but overall, 3-4 decades from now, I don't think it makes a huge
If we don't
difference.
have something extreme, let's say, yeah.
Like very high inflation, and because governments like to print money, that's the nature of our system. Inflation maybe it's a danger, so I totally agree with this opinion.
Okay, okay. Thanks. So if there is no other, if you don't want to add anything else, we can continue. So on December, like that was a few months ago, we talked again about AI, and it's one of the subjects that we wanted to talk again. So I presented the idea that I like the picks and shovels idea, and these are some of the stocks that I own. I have added also ASML, and we can talk more about AI. But this is the outcome from December. I have also put NVIDIA. It's the one that it's on the main graph. I don't own NVIDIA, but I own all the rest, and I have been owning them like for more. So my returns there are pretty good despite the recent drop, and I still believe that they are cheap. And I can say more about this, but generally I would say that I believe that AI might be underhyped in some sense, overhyped sometimes in valuations, but underhyped in what it can do and how people perceive it. But I want to listen also to opposite opinions or any other opinions. How do you think about it? Because as months, yeah.
Well, side note, I'm a data scientist. I don't disagree with the capabilities of the technology itself. Just the reality is that most businesses just don't have big data sets, and I think that's something people are not paying attention to. That's all I want to say.
Yep.
Can I ask?
Yes.
What do this number represent there at the top left-hand side corner?
Right corner.
The left. So it says Micron, the last stock, with yellow, orange.
Oh,
The table.
this is Samsung. Sorry, this is Samsung. The top one is Samsung. And
Yeah,
it's
the last one is Micron, right?
Yeah, and they are the
Well,
price. I think it's the starting and the ending price.
Okay, so you bought at 73.
No. This is when I presented
Okay,
in
okay.
December. I have been owning them like probably more than a year. So they went up like more than 2 years, and then they are probably in the range of 70-80% profit
Okay.
for me. But and I still believe that they are cheap. So, but we can talk more on that. I don't know. And who else wanted to add something? Yeah.
I think I agree with the picks and shovel strategy, right? Because there's going to be a long range of AI. I think if you look at it from a company perspective, I think that now the use cases are being clearer that developer productivity goes up 30-40%, right? Things like that makes sense. If you ask the CEO today, what makes sense in AI, those developer productivity, the chatbots, so your customer agents, you don't need that many of them. Those couple of things make sense. So and the contracts management, reviewing things and compliance, all of that makes sense. So there is some use cases. But I think if you look at the big tech so picks and shovels, I think for the long term makes sense. Some of the companies like Nvidia, I don't know whether the returns of all those investments in LLMs will play out. So there could be some, which we're seeing in Alphabet and the like, right? There could be some pressure on some of those Magnificent Seven stocks because of what are those returns, right? I think that's making some of the big investors worried in terms of where's the return on capital on all this AI investment. Having said it, if you see a long-term play, I think picks and shovels still make sense, and some of the names you have, are sensible. So agree with that approach.
Other thoughts around? Yeah. Because I started with the pro IIDs, and maybe most people want to say that they are
I think
not pro AI. So
maybe people aren't going to like this, but yeah, in the gold rush, picks and shovels were the thing to buy, but what killed the picks and shovels? Bulldozers, pneumatic drills, other tech which came along, which was not the picks and shovels. So that's it. The pneumatic drill killed the picks and shovels. It's the important thing to remember.
Other people, on general ideas of how you think that AI is gonna develop, let's say, how you expect it to be, like, talk freely how you see it in your everyday life.
I think when you think about something like AI, you need to think about other technologies that have come before it. So if you think about electricity, for example, when the light bulb was discovered by Edison, it took decades before it even was in everybody's home. So there is a lot of hype around AI. Of course, there's going to be incredible changes, but we do not know what those will be. And those changes will be system-based. It will be something that we cannot think of right now. So we need to avoid, I guess, if you look at the picks and shovels, it's fine, but to think that some company that adds AI to their annual report or anything and think that they're doing anything with that and producing any returns, I think that's foolhardy.
Yeah, that's a good one. More thoughts around? Yeah? Okay.
I would just ask, has anyone done any valuation properly on this, or like a DCF or something like that? Or is it just not something that we can do? Like, have you done it?
For which stock?
For any of those AI stocks?
I have.
This?
That's hard. I got paid to do it,
Okay.
that's why I did.
Okay, so
Yeah, so I did a stock report for Nvidia, got paid like $1,000 to do it. Very difficult to value a company like that because it's all growth and it's in the tech sector and there's so much things that can change. It was hyped up, the valuation seemed excessive, obviously excessive, and I'm a value investor, so it's very difficult for me to get to that valuation even with optimistic assumptions regarding growth. I think I assumed growth was 40% for the next 3, 4, 5 years, and then 20% thereafter for like another 6 years, and then I think the terminal PE was also quite high. It was a bit riskier than I thought because a lot of the revenue was derived from overseas, and it was exposed to Taiwan, and it was quite difficult for them to get the chips they needed, and they needed high quality materials. So it was a lot riskier than people thought it was. But I think people just thought, I'm going to buy the next lottery ticket and the stock's going to go to the moon, and it was more an emotional decision rather than some sort of cold calculating NPV. So that's why. So that's what I came to the conclusion of. But I mean, it's gone up 100% since I wrote the report. So I've obviously been wrong so far.
Yeah, so I've done valuation around 90, so that doesn't means anything. The real difficulty is that they're doing things no one else has done before. So cash flow multiplied by 2 every quarter. So it's almost impossible to value. You really need to take moonshot things. I don't think it's a lottery ticket. I mean, there's a cash machine in this company. No one is getting anywhere near them. I understand that one of the problems their customers are also their competitors. So they're trying to do their own chips. But what I understand, they could get them for free. They could give them for free because they're more efficient than the competitors. The competitors would still buy them. It's really difficult to value that. You're probably better off. I mean, you've done very well. No one told you you've done very well, Dimitri. I think it's you we should be listening to.
Many times I have also shared my failures, like Safe Style or Super Dry. So haven't always done well. And on the DCF side, I would dare to say I never do DCFs. When I go to details, I have found that details will give me sometimes the chance to see things that they are important. But DCF by itself, I would prefer just to see a PE, like a 5-year projection of how it's going to happen, and then in these 5 years, a multiple, a terminal multiple. So if I know, let's say, that this company will be triple in size in 5 years, and then I can put a multiple. I find this more intuitive and more practical. So that's my heuristics. So I don't do DCFs to answer to that question. Yeah.
No, that's fine. So, what's your terminal PE in 5 years for your business?
I would say that I feel very comfortable for a PE, but I don't want to make it I feel very comfortable for a PE of 20 when I see growth that doesn't demand a lot of capital investment. If it demands, it should be lower, but I feel very comfortable. Like if I see a company with a PE of 20 and good growth without capital requirements, I'm really happy, because even if growth stops in 2 or 3 years, at least I have lost, I don't know, 20%, 30%, I'm close to fair value even if the company stop growth. If the PE is 30, I know that I risk something more and very good things have to happen. So I won't initiate a position in a PE of 30, but I won't sell at a PE of 30 if I believe that the growth could continue for a few years. So probably 20, a PE of 20 is the margin of safety that I apply. So that's the idea, more or less.
And those guys are negotiating.
Now they are not trading at a PE of 20, but when I bought them, they were close. And the only exception, I think, is ARM. And I think the reason that I bought it is because I think they have a huge presence and they don't monetize it. So it's a hugely under-monetized situation. So I thought that these earnings that they present now, they are not nonsensical, they're much bigger earnings. So it's the only exception, and it did very well. And then the P, don't know, went to 80 or so. But yeah, I don't sell easily, but I can buy at those P's like 20 or yeah. So anything else generally on AI, because we stayed here for a while. Just what a last comment. To what I thought a few months ago, AI seems to progress faster than I thought, and it can do more magical things on the background. So, for example, if you see for coding, there are some real use cases or agents that they're really more impressive than we thought. And how fast the models are getting cheaper and better, they progress faster than I had thought. But let's say how fast they get into society and people use them, like the adoption is not as fast as I had thought. So that's a quick one. If you want to add anything on this, and then we can continue.
Yeah, yeah, I certainly agree that picks and shovels, it's a great concept. Probably, I would just add, in a gold rush, picks and shovels themselves are like more predictable animals, right? So you can, like, they're more linear. You like need just more picks and shovels, and they do the same and stuff. So I mean, here. Picks and shovels are not that simple. You cannot predict like in what way they can develop, and it's again, gold is just under, it's doing nothing, but these software applications and language models, they are also unpredictable, so it's tough to predict again some interaction between software, hardware, and to reliably imply this quantitative side of hardware, if you will. So yeah, that makes it tricky, in addition to obviously stretched valuations sometimes.
Because we have kept the intro a bit longer, I think, but yes, one last.
To add on this very interesting comments, just because you think an industry will do fantastic, that doesn't mean that the return to the shareholders will be the same. Because if you see the airline industry back in the 50s, 60s, it was the hype of the day. But if you see what owners got back, the return is negative, even if they owned every airline. Why? Because the competition was crazy, and also because the capex requirements that they have just to keep going, they're so large that they need to retain their earnings and then pay so much money for this capex, which is inflation adjusted. It means it goes up, that there is nothing left to people who own the company. So the airlines since the 70s actually have returned a negative figure for the owners. It's great for civilization, but it was not very good for owners. Now AI is a bit different because the capex requirements are very, very, very low. So the returns on capital employed are very, very high. But just because you think an industry will do great, that doesn't mean as an investor you will make a lot of money. The same happened with cars in the 20s, by the way. But yeah.
This is a valid point, and that's a long discussion. Yeah. So, if it's anything very important or something that we didn't cover, and somebody wants, and especially if somebody who hasn't talked yet, we'll take the last one. And now we will move to our speakers and to the presentation of the company. Somebody that hasn't said anything yet, and they need to add something that they think we have missed. Here is the chance. Okay. At the end of the event, I will also share a video about, we'll see a video about our new product, the DCSC, which is a classification system that offers granularity, and we have some great tools. So for example, this is the classification tool that you can put your stocks, and you can see how the company is split among different sectors. And we use AI and our news corner to build that and see how each company is related to that. We have, let's say, different ways of doing that. You'll see a video later about this, but you can always go on dcsc.ai and check the product. The Smart Portfolio is another tool that you can, let's say, put the sectors that you are interested in. You can build a portfolio, and you can find also opportunities in that sector. Anyways, thank you very much. That was a long intro. I wanted your participation and your opinion, so that was a long one. And now we will move to the presentations and our wonderful speakers. Give me just a second. Thank you. Starting with our prepared presentation.
That's what I was saying, blood on the street. Hey guys, hello. So my name is David.
Just give me one second. I will. Okay, you are ready. Go. We have David here that will present Technoglass. So
Okay, so first question, has anyone ever looked into this company? Okay, that's great. So it's a small one. So just a few words on myself. I don't define myself as a value investor. I'm more of a quality investor who tries to get great companies at a value. So I first find good companies, great companies, and then I check I'm not paying too much for them. I'm not an analyst or something like that. Daily life, I work as a CFO for a manufacturing company, and at night I'm a private investor. I do a bit of options as well, and I have a blog, so if anyone who wants to read French, very interesting articles, investir en bourse malin, which means like clever investing, basically. So why I decided to focus on this company, Technoglass, that no one knows about. First thing is that it has great numbers, has very interesting business model. As a company that works in Windows, I'll go into a bit more detail later on. It's not your traditional sexy AI, sexy tech, sexy Paycom, that will be for later. So it's quite interesting if you want to diversify your portfolio with things that people don't look into that much. It's an owner-operator stock, so I try to look for stock where the management has really skin in the game. And the last point is that it has good tailwind. So when I'm buying a stock, I'm trying to make sure that there is secular movements that will help it grow in the future. So, what is Technoglass? So a company that designs, manufactures, sell and install Windows. Their business model is a bit special because they manufacture in Colombia, so they're based in Colombia in terms of operations, but 95% of their revenue is in the US. So they build, then they ship it to the US and they sell it there. The other thing that's interesting with them is that they own the entire chain. So they install as well as customers. Companies who tend to do that are the very best in the market and they make good margins. So cars, for example, Tesla is doing that. Apple is doing that. Nike tried to do that, they didn't really succeed. But generally, if you own the entire supply chain is really good because you cut the middleman. You make their margins yours. In terms of market cap, it's now officially mid-cap, so it's over $2 billion. Obviously, it's 150 times smaller than NVIDIA, for example, so it remains quite small. Don't know if you can see at the back, the revenue is 833 million, net income of 183. So for a company that does Windows, that is a very good result. In terms of cash flow, free cash flow, so it's the cash flow generated by operations minus the capex, is only 61. But it's a company that's been growing quite a lot. They invested quite in terms of capex. So again, it's generating a lot of cash. So revenue breakdown, I'm pretty sure at the back you can't see. I couldn't. So the markets, they have basically two markets. They do single-family residentials, which is, you know, houses that are probably like $1 million or something like that, where they do architectural windows. Sorry, that's representing around 40% of their revenue, and it's very high margins because people who can spend this sort of money will buy quality windows, let's say. The other 60% are for commercial, so that's offices, warehouses, everything that's related to companies, and also multifamily, so that's blocks of flats. Now, what is really interesting, and you can't really see it here, in 2017, they decided to do a strategic move and to go into single family. They went from $10 million in 2017 to $325 million. So they had a growth that was amazing on that side. On the other side, they still managed to make 9% growth over 6 years, which in total meant that they made an 18% CAGR growth every year. That's quite impressive. I mean, a lot of tech companies would love to have these kind of numbers. And you can really see that, let's say, from around there when they made this strategic move, revenue went up dramatically and the results with it. The margin went up because they were doing, obviously, I was saying that they make more profit on the single family, and also because when you're a manufacturer, you're starting to get some scale. And they invest a lot in automation, so they were making more margins in that sense. Now, what is interesting is that basically, again at the back you can't really see, but we don't know exactly, but around 50% of the business is Florida. And now what they decided is to go in other places in the US. So they created, they're starting to develop in Texas, in California, they're trying to do New York as well. So imagine if with one state they do, let's say 500 million, they can do very well in the future. The other thing that is quite interesting, today they were only focusing on aluminium windows, and they decided this year to go into vinyl windows. Aluminium is 20% of the market, vinyl is 63%. So I'm pretty sure no one knows why they were doing aluminium and not vinyl. So US being so large, you need different windows in different states. So in Florida, you need aluminium windows that are very strong to be able, if there is a hurricane or something, it will resist. And there was a big push by insurers to make sure that all windows were changed and so on. So they benefited from that. In New York, for example, you have in the summer 40 degrees Celsius, and in the winter minus 20 degrees. So you need very efficient windows. So it means that you need different products. And they're doing that very well in the fact that now they're launching their vinyl. But it means that in a way, the market is going to be tripling in the next few years. So that's very interesting. Now, it's a narrow mode business. It's not wide mode, it's narrow mode. Mode because they manufacture in Colombia. It's really hard to know, again, they won't tell us, oh yeah, I'm doing it 5%, 10%, 15% cheaper. According to my calculations, give or less, it's probably 15-20% cheaper in Colombia than in the US. The average salary in Colombia is $1,000, in the US is $5,000. So on that front, they're clearly saving a lot of money. The distribution, not bad as well, because you have a lot of boats that goes from the US to Colombia, and then instead of going back empty, they can put their glass in it, and it will be probably it's much cheaper to send things from Colombia to the US than the other way around, so they benefit from that. The fact that they have an integrated model obviously helps them distribute their products and also helps in terms of reactivity. You don't have the middleman. You can say to yourself, people on the ground, okay, you're struggling with this, you're struggling with that, we can react. And actually during COVID, they had a much quicker lead time than competition, which meant that they gained market share at that time. And we can see in the previous slide that during COVID, they did very, very well compared to competition. The other thing I said is two brothers that are managing it. They founded it around 30, 40 years ago. And they have a talented CFO, important stuff, especially for me. Now, the big thing is, do they have the ability to replicate the success they had in Florida and other states? Management, it's always important for me to focus on management. At the end of the day, you give your money for them to manage it. So, pictures of those people, I think probably they took it a few years ago, I must admit. I think they slightly changed, but they're still good looking. They own more than 50% of the business. The CFO joined in 2016. I think he really contributed to steady the ship. And you can tell that the numbers really picked up more or less since his appointment. So I'm not saying it's just him, it's a team effort. But he's doing very well in managing very well the balance sheet. Actually there is almost no debt. They're buying back stock. He changed from, for example, from NASDAQ to New York Stock Exchange. You have more liquidity and all that sort of things that you don't really aware, but he's done very well. Now, I need to talk about Hindenburg Research. Does anyone knows who Hindenburg is? Yeah, so the few who knows, can you tell me who they are? Yeah, short. Yeah, so they're a short seller. And do you remember which company they shorted quite recently? Wirecard, yeah. Wirecard is an interesting one because you could have shorted it for 10 years and then losing your shirt. Now the other ones, don't know if you remember Nikola Motors. There was this video where they were saying that the truck was going normal, and in fact they took a hill and it was rolling down, and the way they managed to take the video, you had the feeling it was rolling on electricity, and it wasn't, it was just gravity. So they're the ones who did this report. Now, they did a report in 2021 on the company. It was mainly on the owners. Back in the 90s, the owners were accused of drug trafficking. Now, if you read the report, I must say it's quite biased. Yeah, exactly. So we have Colombia. So, yeah, it's Colombia. People doing well in Colombia. They're living in Barranquilla, where apparently there is a lot of drugs going on. So they must be criminals. Now, the reality is they were on trial both in the US and Colombia. They were both found not guilty and acquitted. Okay. The other thing they said, I think it's Christian, he did go to jail actually, and he went to jail for something that he got caught with, which was tax evasion in Colombia. Okay, to be honest, as shareholder, I'm less bothered by that one. It's just he got caught. I'm pretty sure that everyone who owns Amazon, Facebook, and so on, you all know that they do it, but they do it legally. That's the main difference. They're not getting caught. And there were something doubts on revenues. Now, it was like saying, yeah, they're selling to the nephew of the husband and stuff like that. Now, I don't really know how business is done in Colombia, but you have some countries where you have a lot of family business. Is it really a problem? Especially they were talking about 3 million here, 6 million here. Well, if you do 800 million revenue, I don't really care if you sell to your brother that has a distribution center. So again, I wanted to put it out there. Don't be surprised, but it's part of the investment analysis. Now, it has great numbers. I talked about the growth, 17% annually for the past 5 years. EPS jumped 74% for the past 5 years per year. They're not going to replicate that, but that was amazing. Yeah, Giacomo, your eyes are struggling, yeah? No. Yeah, he's impressed. See, I impressed Giacomo. Gross margin 47%. For manufacturer, for physical goods, it's really good. You know, companies like luxury is around, is over 60%. So 47% for Windows, it is really good. Operating margin 31%. That's levels within the tech. Cash flow, operating cash flow 16%, that's quite good. Return on capital employed 36%, again that's very strong, and almost no debt. Now what you can see is that outperformed over the past 5 years the Nasdaq, S&P, so you can't really see at the back, they did 590% price, and over 10 years is only 380. We were talking about the UK investors, so I'm sorry, UK investors over the past 5 years, a lovely 9%. And maybe you had a few dividends. But anyway, clearly they've done very well. Now, business risks and challenges. Elephant in the room. We were talking about macro. Now, Trump is the one who's talking the most about protectionism. It's not just China, he's threatening to do the rest of the world. I think he's been talking about 10% flat duty rate on everything, every country. That might happen. I don't know. Now, if I'm thinking about it, probably 30 or 40% of their costs are coming from Colombia. It's the cost of the windows. So if you say that he puts 10% on 30, 40, it means that the cost will go up 3%, 4%. Yeah, I don't like it at all, but will it stop them doing very well? No. So it's not really a concern as such. Hindenburg research, yeah, the stability of Colombia, the Forex, accounts accuracy, they're now headquartered in the US, so it's a US company. They're audited by PwC, which is the top 4. I don't think there is a big problem there, but need to put it here. It is a cyclical business. So, you know, you were talking about Labour wanting to build 1.5 million houses. Well, I'm sure there is a few of you are thinking, well, okay, that's good, David. What happens if real estate crashes? Well, in reality, depending on the years, but around 60% of the revenue is coming from R&R. R&R is remodel and repair. So when you change people change their windows much more often than buying than buying a new house. So it's not really a problem as such. The main challenge is to absorb the growth. There's just something that I missed early on. Try to invest where there is secular tailwinds. Now, you have urbanization, so population tends to come down south in the US. So it means that more houses, there will be more buildings being built, and they're trying to work on that. The other thing as well is that 85% of the revenue is helping with global warming. So generally is more efficient windows or windows that resist more, or garage doors that make sure you don't need to heat your garage or things like that. So really you have tailwinds behind it. But yeah, the challenge is absorbing the growth. I'm confident on that. I think they will be able to absorb the growth. They always try to have around 30% projection capacity ahead. So during COVID, they were so busy that they were working 7 days a week, 24 hours, 7. Now they're very pleased, they're doing very well. They don't need to work on Sundays, you'll be happy to know, that they have this possibility. And then can they replicate the model outside Florida? Now, in terms of valuations, we were talking about valuations, current PE around 14. Obviously, you can say it's expensive, it's cheap whatsoever. I think we missed a couple of slides, but anyway, I think we missed one slide. I missed one slide. But below the past 10 years average, obviously you need to take into account growth. So you can have a 20 PE if you're growing 50% a year, that's nothing. Or you can have a 10 PE if your profit is coming down, you don't want to buy this stock. So you need to put that into perspective. Forward PE around 15. I did a DCF You'll be happy to know that gave between 44 and 49%, and that was for dollars, sorry, and that was for 10% return, knowing that the stock is currently at $51, $52, depending on how volatile is the market. I also did reverse DCF. So for the ones who don't know what a reverse DCF is, that you try to evaluate how much growth they will need to do in the next 10 years to validate the share price that's currently there. And I found 9.7%. 9.7% is not that big, because if you remember, I was saying that in the old business they were doing 8-9% a year. Now, if you add the growth they will have going into New York, going into Texas, going into California, and so on, and if they're able to do the same thing, going from $10 million to $300 million in those states, it's pretty sure they will achieve this number. But again, need to be careful. I'm not sure they will be able to do it. And last one for the ones who have Morningstar or are on interactive brokers. Interactive brokers, by the way, you can have those values for free. To give you a valuation, Morningstar is one of the best websites. They say $69. Me, I think it's between 44 and 55, but always cautious. So at $51, there is no margin of safety. Conclusions: a solid business, has great growth perspective. This is something that's sometimes difficult to find. We tend to find very good businesses, but we don't know where the growth is going to come from, or if there is a lot of potential growth, the share price generally bakes that in, is very high. So it's quite unusual to find something like that. Can be a good buy at the right price. I think low 40s, that would be a good price to enter. I have to. It's quite volatile. And the last point, I think, is quite nice diversification stock. So in a way, you can go into the real estate in the US and have something that is quite solid and diversify, but you have all the problems I mentioned and the challenges before. Thank you very much for listening. Is there anyone who wants to comment? Yeah, Ricky?
Yeah, I use only one just to preserve some energy, because I worry about the good things.
Just a quick one. Do you know what the competitive landscape looks like? Who are their competitors? And other than that, do you know whether there is any risk of a different solution to what they're providing? Like someone might come up with something else that's better than the vinyl windows or the aluminum windows.
It's quite difficult to know exactly where they're positioned. They're in the top 5. So they probably have something like 3-4% of the market. In terms of innovation, there is innovation in the glass itself. Now what they did, they created a joint venture in Colombia with Saint-Gobain. I don't know if anyone knows Saint-Gobain. Saint-Gobain is the biggest glass manufacturer in the world. So and they have an R&D department, and they're quite quick. So honestly, I don't know all the window manufacturers in the US, I must admit, but I think they're quite dynamic. Also, the thing that is interesting, the others, they have increased their prices, they haven't. The others have been more struggling than them. So their revenue has been a bit flattish the past 2 quarters, let's be honest, compared to the growth before. But the others have come down slightly, so they're still gaining market share.
I have a couple of questions. Firstly, can you tell me a bit more about debt levels? Who else has claims on the business? You said that 52% is owned by the insiders. Something else I want to know is, you showed this sort of new revenue stream that they developed over the last, I think it was 8 years. How did they achieve that? Was that purely organic, or was that through acquisitions? How do they deploy capital? Anything you sort of, have you looked back at that, like sort of in the last 10 years? You said they were very sort of successful and saw a lot of growth during the pandemic. I'm sort of curious if you also looked at the sort of capital allocation elements, especially with the sort of Hindenburg story and questions around that. I'll leave it to those three, but like, yeah, curious to hear your thoughts on that.
By the way, Hindenburg did it very well because on the day it went down 40%.
Of course.
It's easy to do accusation. Honestly, I think there was a bit of racism there. You're Colombian, you are a drug dealer. That's what I was saying. So in terms of growth, I think it was organic, and clearly the fact that the growth mainly came from single family. Now it's 40% of the revenue. It was 3% back in 2017. So they buy some local installers and so on, but it's mainly organic growth. In terms of capital allocation, they were indebted, they had debt, now they cleared it completely. There was a slide that has disappeared. I think I had the return on, yeah, you can see the return on invested capital is 24%. So what they do, they invest quite a lot in their factory, they're automatizing, they increase the capacity to do $1.1 billion, for example, and they're buying back shares, and you have a little dividend. I think, I was saying that the CFO is talented. I think he's doing very well that side of things, to be honest. Did you have you had three questions and answer to two?
And then sort of
There are some people that they haven't asked because now we will.
record of capital allocation of Nicholas.
Yeah, I mean, he's doing well. They're clearing the debt and so on.
Yeah. 1, 2 questions, and then at the end we will have more for all speakers. But just to move to the next one, we'll have one in who I think there was somebody else. We'll get another 2, and then at the end we will have more. Okay? Yeah.
Given that I've got one question, I'll probably just throw a few terms at you.
Yeah.
Are you able just to comment a bit more on the growth, on the cost structure? Do you find that it's more fixed or variable? And obviously you would expect that growth to flow to the bottom line. So are they, in simple terms, are they benefiting from economies of scale? Customer captivity, why would someone go with them and not someone else in the industry? And barriers to entry of the sector. And because capitalism is fierce, and what tends to happen is, if they achieve such great numbers, you probably get competitors coming in. So a bit more on barriers to entry. Sorry, just probably a lot.
Okay, so manufacturer. So you have a lot of fixed costs. That's clear. Now, what I was saying earlier on was that their revenue is not going to drop probably 30 or 40% at one go. So they always try to have a bit more capacity. Just keeping in mind, so they do 800 million. If you have 1 billion of capacity, okay, oh, it's great, they have 20%. But for the ones who work in factories, sometimes you are plus 40%, and sometimes you're down 20% in a month. So you always need to have a bit more. You know, it's not, the demand is not like you get a 12 every month. So you always need to build it in. Now, in terms of economies of scale, yeah, they benefited from it. Clearly, they're selling more, so you're absorbing your R&D costs, you're absorbing your selling costs, you're absorbing your factory costs, and in terms of barriers to entry, yeah, I mean, one of the big advantages is the cost, because they're in Colombia, and salaries are much cheaper, and everything is much cheaper. The land is cheaper, everything. So, yeah, if you had $5 billion, you could probably replicate it, but that would take time, because also you need to, they have a distribution network. That's one of the big competitive advantage. That takes time for people to trust you with their windows. Just keep in mind that if you take a random supplier, not able to supply you your windows, the delivery of your building is going to be delayed, and that's going to cost you a lot. So reputation is really important in that business. And same thing when they sell windows, normally, at least in the UK, it must be the same in the US. Most countries, you have a 10-year warranty as well. So you can't go with a crappy supplier, basically. Okay, hope I answered more or less. Any other questions?
Thanks. That was a quite interesting presentation. Maybe just a really quick one. You kind of touched upon the cyclicality, right, of real estate and housing. So notice that the actually IPO'd in 2012, right? So a couple years post GFC. How do you gain comfort from the fact that, you know, if you were to have a housing crisis equal to the size of the GFC, they could weather the storm? You know, their balance sheet seems like it's got what, 120 odd million in cash. So do they have enough cash? You know, if things were to just switch off tomorrow, what's their kind of runway?
So first, congratulations, because you went to check how much cash they have and so on, so well done. I did say it earlier on that you have a lot of repair and remodel. That helps. Even if there is a crisis, if your window is broken, if you have a hurricane in Florida, the windows are broken, but you still need to change it. That's pretty clear.
1, 2. That's why I wanted to preserve earnings, because I worry that they will.
And I think, honestly, I don't know that. If you can make financial crisis,
I'll tell them, I will tell them. Continue, I'm coming. No?
If there's a great crisis, I think there will be more other companies are going to die before them. Because, well, I suspect it's easier to fire people in Colombia by costing them less than having factories in the US where you still need to pay workers. But at the end of the day, things like Windows, you need them. But I can't guarantee. There is a great crisis, I can't guarantee. Dimitri is off, so you can ask your question.
So the bloggers were actually sued and they went to court to defend themselves against like drug trafficking, right?
In the 90s.
Isn't that odd enough, and doesn't that cast like enough shadow? Like you went to the US to be trial for drug trafficking. It's not like you were in church and like just selling windows.
No, I mean, what they were saying was that they were helping. Oh, okay. I think it's the owner who's calling to tell you you heard of the Cali cartel? Have you heard of it? No, globally, honestly, the way I read it was you have successful people exporting things to the US, and we are suspecting them to smuggle drugs into the US. That's the way I read it. Now, these guys, they are worth $1 billion or more. Are they really going to bother smuggling drugs for a few extra dollars? I don't think so.
I mean, aren't you sure that you check the windows?
It's all in one.
Laced with coke, right?
Okay, I'm going to send your CV to Hindenburg, yeah?
I mean, is it like a quick one?
Yeah. At the start you mentioned that this is like a non-sexy sector to go in, and this stock is coming from like a small cap transitioning to mid cap now. But if you consider it for your portfolio, what kind of position will you take in? Like what percentage of the portfolio will you go for?
Because there is risk, we saw the risks, not drug trafficking. There is risk. I would not put too much. I would probably put up to 5% or something like that. But that's me. Now, if they triple in size, I'll be kicking myself. But yeah, I'll probably limit it to 5%.
Okay, so a big round of applause for giving us all these deep insights. So now we will have our next speaker, Alex Grishko. Do I pronounce it well? who will present Paycom. It's this idea of 20p that it grows. So initially we like them. Let's see. Just let me. Give me just a second. I think now you should be fine. Okay, and do you have them? Okay, it works. Okay. And if you stand a bit here, people can also see you from the camera. That's awesome, like a bit. Yeah, fantastic, fantastic.
Hi everyone, my name is Alex. I'm going to present Paycom software, which I think at current levels might be a good opportunity to add some quality to your portfolio. So, what is Paycom? Paycom is a leading provider of payroll and human capital management solutions. It's started as a payroll company, and then it was adapted in cross-selling of broader HCM services to its clients. So it was founded in '98 by its current CEO and chairman, IPO'd in 2014, 10 years ago, at around $15 per share. So it made 10x to its current price today, around 26% compounded. So it covers wide range of HR functions, but again, starting from payroll and other services built on that. It's delivered as a software as a service solution, and it's built entirely internally by the company, and it's been growing organically. It's maintained in a single database. It's actually a closed database, but yeah, we will discuss later on the features of the product. So business model, it's a subscription-based business, charging corporate clients based on per employee and per pay cycle basis. It's quite a sticky business. I mean, when the company is doing payrolls.
I have told them to charge them. If you can just be louder, okay. Initially, and I will find a solution about it. We already have it. You see, just on time. Thank you. You're amazing. It doesn't work. This one doesn't work. Sorry, Alex. No worries. One, two, three. So this will last. Yeah. Okay. Okay. We're okay.
Here we are back. So it has subscription-based business model. It's quite sticky business. The companies don't change their payroll providers that often, actually. Currently, it has market cap around 9 billion. It's actually went up 5% today, so it's a bit more now. The company mostly focuses on medium part of the market, like typically typical client is like 500 to 10,000 employees. They began targeting enterprise market last year, but yeah, it's in progress. So in terms of market position, the company has almost 37,000 clients, representing almost 7 million employees. It's about a bit more than 4% of all US employees as of the end of the last year. So in terms of the industry, Paycom has been gaining market share from larger peers like ADP and Paychex for the last 10 years, and currently it holds about 5% of the market. So competitive landscape, there are several, couple of large players like ADP and Paychex, and like mid-market, and several players in enterprise market like Ceridian and Workday. So Paycom is mid-market player, quite successful. But yeah, it's quite a competitive market. However, it was excellent industry to compete in, because even large established players like ADP had around like 5 to 10% compound annual growth rate over the last 5-10 years, with again 90 plus retention rates. So actually numerous players benefited due to growth both in payrolls but also from HCM software and automation. So yeah, it's a bit paradoxical. The market is quite competitive, a lot of players, but actually a lot of the players are doing very well in terms of growth and margins. This is growth over the last 5 years. It was even more impressive over 10 years since IPO. So basically the company has been growing its revenues at 25% plus over the last 5 years, and EPS was growing even faster. So yeah, why is it high quality business? I think first it's more than 98% recurring revenues, 90% retention rates, stellar growth even by software company standards, profitability 84% gross margin, industry leading, again quite stable over the last 5 years, same with operating margin, good return on capital, rock solid balance sheet over the last 10 years, no debt, cash position currently. So yeah, quality is here. It was well recognized by the market, so average PE over the last 5 years was around 65. But yeah, it's 10x over the last 10 years, and so it benefited long-term shareholders, but over the last 5 years, and especially recently, it was not that good. Actually, we see that 1 year ago it was 360 stock. So actually in Q3 last year, management shocked the market saying that they anticipate growth in 24 in the range 10 to 12% from 23, 25. So it was 40% one-day drop last year. It went down from its peak 550, like 70%. So something happened. So what happened? BT, basically better employee transaction interface, its latest payroll innovation from Paycom. Basically, this payroll solution is quite differentiated in the market. It allows employees to do their own payroll, to check the numbers, to verify before submission. It was launched actually in 21, but over the course of 22 and especially last year, Paycom was actively moving their current clients into this new solution. First of all, why Betty disrupted results and growth and caused all this suffering for Paycom if this is such a good product for clients? Couple of things. Firstly, management admitted last year that this product cannibalizes part of revenues, namely services revenues, and if you like additional payrolls, which comes from mistakes, because Betty dramatically reduces number of mistakes and payroll runs, which are billable by Paycom. So, secondly, the way Paycom was pursuing this switch for current clients was quite aggressive, even too aggressive. So, sales team that was in charge of this, it's basically was same sales team that's in charge for cross-selling of HCM solution, and basically they disrupted both lines of business. They stopped to cross-sell, and they basically were not ready to switch clients, and some clients are still reluctant to change. So, yeah. In terms of negatives, I mentioned. So, in terms of positives, it's really highly differentiated product, the only one in the market. It engages employees, it reduces mistakes, like by almost 80%. It reduces time needed for HRs to process payrolls. Also, this product has higher stickiness, almost 99% according to pre-23 data. So it's highly differentiated product that adds a lot of value to the clients. In terms of current rollout, 2/3 of clients already use Betty. 50% of their employees do their own payroll. So, yeah, Betty and also slowing growth. The growth was around 11% in Q1. Also, a couple of months ago, it was unexpected departure of co-CEO only after 3 months in the role for personal reasons. So it also did not add positivity in the market. So all this caused like rapid shift in market perception. I think like concerns are somewhat overblown. So let's discuss. In terms of slowing growth, despite slowdown, actually we still have 10 to 12% growth, which I think is durable. Also, recently they reported encouraging growth in larger clients, 11% in clients with 500 plus employees, and impressive 18% growth in clients with 2,000 plus employees. That may hint that they are doing progress in enterprise clients as well. Recently they've done 3 and 4 million deals per client. So in terms of lower retention rate, it was a bit lower than in 22 and 23. However, they said that this relates to like really small clients, which constitute only 3.5% of revenues. So I think the product is still quite sticky. Macro-related headwinds were not that important actually, only affected pre-employment services. In terms of management issues, co-CEO departure, I don't think it's a big deal because CEO is quite experienced and there were no any disruptions. Main thing is newly appointed marketing officer and especially chief sales officer. She was quite successful when she was head of external, outside sales for new clients. Now she's in charge for existing clients as well. So we will see. But main question obviously is competition and product quality. I think in terms of competition, Paycom has been doing quite well for some time. So the main question is product. I think Betty is well differentiated product, and the client will recognize its value. Yeah, they rolled out global HCM solution last year. They developing payroll solution and already introduced it to Canada, Mexico, and UK to support their existing US clients. Also, again, it relates to management and product. Management currently is very focused on product. It was a leaked video on YouTube in winter with CEO. It was like secretly recorded. It was another shocker which added to market concerns. But what I like from this video that Chad Richardson, CEO, he said, I don't want to go skiing, I don't want to go on vacation, I don't want to do nothing, don't want to speak to investors, I just want to focus on product. Both in terms of new specs and quality of existing products. So I think recently a product department again began reporting directly to him since September. So with rollout of also GAN platform, which is automated solution for time offs, I think product actually is in a good place. And again, Betty is a core product offering. It was rolled out in 21. Since 21, it was the only product which was intended for new clients, and both in 22 and 23, it was like 20-25% growth. So I think question is not in quality of this product mainly, but how they will be able to further monetize Betty and HCM software which they cross-sell on top of this offering. So, why now? For years, Paycom has been trading at like premium multiple, even by software company standards. It was average, 5-year average is 66 PE. Price to sales 14. Currently, it went down a lot, so valuation is much more reasonable. It actually went up over the last 3 weeks, like 20%. It was around 140 per share. And also it was not related to recent drop in Nasdaq. It actually went up. So yeah. Just to put valuation into perspective, several companies from application software sector. This part is competitors of Paycom, and higher part is just more well-known names. So we see 5-year revenue growth and growth last year. We can see like visible slowdown in sales like throughout like enterprise software industry. Paycom did quite well both 5 years ago and recently, despite slowdown. It's especially visible against more established competitors. In terms of margins, also quite good. So, yeah, I think that in terms of business quality, growth and operating metrics, it's on par or close to like such names as Adobe and some cybersecurity names. So that's why I think nothing wrong is competitively with the business. I don't expect reacceleration to 20-25% like this year, obviously, but I think management guided quite conservatively. They beat Q1 estimates. So yeah, I think at these levels or a bit lower, it's even more compelling. I think they are able to produce a low teens growth and reaccelerate probably over the next 1-2 years to mid-teens or high teens even. Yeah. Thank you.
Now some
questions?
You said the founder is involved in the business, right? And he still owns 11 or 12% stake.
Yeah.
And has he been sort of buying more stake recently? Has he been active? And then can you talk about Betty? You said obviously you're now selling to more than half or 2/3 of the customers, but why is it still then so small percentage of revenue, as you were saying somewhere in the presentation? And thirdly, lastly, if you can talk about the growth prospects, not 12 months, but forward 25, 26.
Yeah, sure. On management, Chad Richardson owns 11.7% of stock. He has not been buying recently. Even you can see that everyday news pop up that he is selling like 600,000 of stock daily, but this is pre-arranged sales according to stock selling plan, so it's very minor sales, so I wouldn't conclude anything bad from that. On buying stock again, they opportunistically buy back stock. For example, it's not like huge number, but for example, in Q4 last year, they opportunistically bought 2% of the company. I believe at quite an attractive levels, so below today's price. So I think he still sees value in company's stock. Also, just a little bit on his remuneration and stock-related things. I didn't have time for this, but 3-4 years ago, it was a shocker in news that Chad Richardson is the highest paid CEO in corporate America. So it's probably less well known now, but his remuneration was in a range like 200 million, obviously with stock and stuff. So this performance-based remuneration was linked to some performance and stock performance targets. But funny enough, I found out that he forfeited his more than 100 million of remuneration earlier this year in March, because it was automatically, this forfeiture was triggered by exit of co-CEO. So he basically left this 100 and something million. Also, his salary over the last 2 years was just 3 million. Smaller competitor CEO earns 21 million. So I think fine in this regard. In terms of Betty and its contribution to revenues, again, management admitted that it's a low number, but I think it means that Betty itself doesn't add to revenues. So they don't charge existing clients for switching to Betty, obviously, but it's a billable item, it's their main payroll solution. So I think and they actually didn't increase prices too much. They're not too transparent on pricing for competitive reasons, but I think that they want clients to switch to Betty and then cross-sell other HCM applications which are built on top of Betty. That's why they were very aggressive on that. So yeah, what was the third one? Internal, gross prospects going forward. I mean, I don't like aggressive assumptions. For example, as David said, Morningstar price target is about 260. It was updated in May, so I think it's way too aggressive. They imply something like 33 multiple, I think, and I think even if we input like conservatively 10 to 12% over the next like 5 years, it will do fine. However, I think we can expect some reacceleration closer to mid-teens from several drivers. So firstly, from adoption of Betty and HCM software built on top of that. Secondly, their upmarket strategy is gradually working, and probably in 3 to 5 years, this expansion into large markets, Canada, Mexico, and UK, also going to play out. Again, some analysts think that this payroll solution for employees is so revolutionary that all the other market players will need to switch and to develop similar solution. I'm not sure. I think this is way too aggressive, but I think it's really differentiated solution, and I think we can expect like around 15% growth, which is durable. So.
Just a quick question. How much of their growth was number of employees versus price?
Price per employee?
Well, they charge, well, one trying to look here is quantity versus price in the growth. I have my own assumptions, but I don't believe the working population in the US is going to grow exponentially from here.
Yeah.
So I just want to understand how much of their past growth was like more employees coming into the payroll versus how much they hike the prices.
Okay. They've not been hiking prices, at least recently, when they rolled out Betty, so for 2 to 3 years it was not price-based. In terms of growth, we can expect from, let's say, growth in number of employees. We can see that, for example, ADP has been growing at like mid-single digits. So I think this tailwind from growth in payrolls and employees, it's like 3 to 5% maximum, but I think it's a shift of the market towards automation, towards larger players which actually can provide like more functions, better service, and so on. So I don't think this growth, the experience like 30+% growth over like first 5 years and 25% growth over the last 5 years, I don't think it was based on huge increase of employees. That market, like, you know, it was.
Was it driven by quantity? They grew the quantity.
Okay. So what I mean, for example, in terms of number of clients of Paycom, this number has been like growing at around 11% over their history, and the number of employees they serve payrolls, it also was steadily growing. Why actually Paycom has been able to achieve such a stellar growth even like over the last 5 years? It's mostly because they've been taking share from ADP and Paychex. They've been growing faster. And also to it, probably on long-term growth prospects, I think they mostly relate to whether they will be successful in upmarket. To less degree, it relates to other countries. I think it's remained to be seen. So I would say they were successful. However, the thing is, for example, ADP provides payroll services among like a lot of countries internationally. So for large clients, it's a must-have feature. Paycom obviously doesn't have that. This is number one. And secondly, Paycom software, it's a single database which is quite close. So they don't allow to like API or integrations with wide range of third-party applications, for example, accounting applications. So for some clients, it also can be like larger clients, it can be an issue, but so far in terms of their upmarket growth, I think it's promising, and I think this 10 to 12% growth, it's durable one with positive possible upside.
We will take 1, 2.
and then we will move to the next one, right? So one here, and then you, and then we'll go to the next one. And at the end, we will have more, okay?
I like the bit you just said, like about like API integration, because that's sort of touching on what I was going to ask, is sort of how Paycom sits versus competitors, because the way I sort of see this is like it's very much a SaaS business. It's revenue sticky because corporate clients sign up for multiple years and go through like a sort of administrative RFP process. But then knowing that all corporates do that, they need to sort of come out on top in order to be chosen naturally. So I don't know if you kind of can touch a bit on how they compare versus other payment providers, because this does seem like a sort of pure competitive market. So what makes them stand out to like sort of float to the top in the RFP process? Thanks.
Yeah, sure. So I think that this problem with Betty was to some extent self-inflicted problem, self-inflicted situation, because they basically decided a couple of years ago they're going to change their platform to involve employees. When employees basically do their own payroll, it I think was a risky bet at that time. So this is Betty is the only solution in the market right now that provides this engagement from employees. Why is it good? Because it's more sticky, because employees know the solution, they want transparency, what they're going to receive when payroll is processed. So with other providers, employees don't see payroll, they just receive some mistakes and stuff. So this is one thing. Secondly, I think what else? Yeah, this is differentiated solution. I think this is main thing. Obviously, they have like friendly interface, but I think many competitors can say this as well. So yeah, I think mainly it's differentiated solution. And also, second part is that clients' ROE is much higher because it reduces both mistakes, saving time and money for billable payrolls. Also, it reduces time for HRs because they are less involved. Basically, large organizations, they leverage their employee base and reduces their costs and costs on HR department. So yeah, that's the solution. And this was a big news in terms of cannibalization of revenues, service revenues, and payrolls with but these revenues basically they are quite small, about 5% of Paycom revenues, so it's not a big concern. Yeah.
Okay. One last one, and then we'll move to the next one. Okay.
Hi. Great presentation. I was just curious, like, what's actually the workflow difference between some of the legacy payroll systems that we use in Betty? Because it's great, like, retention rate, and it's clearly growing. But I'm just curious, like, how is it different?
In terms of product, right?
Yeah, in terms of product.
So yeah, we got several quite established providers like ADP and Paychex. They've been doing this for like years and years. Paycom's product was developed internally from scratch without any acquisitions. It's like really good product, cloud-based, cloud-native. So I think there are some advantage from this point. However, I would not rely my investment or my thesis on like some better interface, right? Because ADP actually caught up with smaller players. They also offer payroll and HCM related solutions. They got very well established client base who trust them. They have, I think, probably 10x more employees serviced. So I would say big differentiation is this. I think that's why Paycom decided to switch to Betty to really differentiate and to provide really value and time savings to clients. So I think that their solution is better software-wise, but again, for large clients, it's not like big deal because this solution is used not by employees, but by HR and accounting department. So yeah, I think if the game will change and it will be like employees will do their own payroll and other companies will provide similar products, then it will be advantageous to Paycom because they are first mover and stuff. But at this stage, yeah, I think this is mostly Betty and also general stickiness of the business and yeah.
Big round of applause for Alex. It was a great one, and we hope we have you again presenting. It was a great one. And now we have another Alex, my friend Alex Stuart, who's going to present Pershing Square. Yeah, we're going to
go to the toilet again once.
Yes.
Just set it up on.
Just give us 2 minutes.
Just need to load yours. Which is here basically. Cannot see. It must be somewhere. Yeah. So now if you try, it should move. But don't do it yet because I need to do something. Just give me.
How do I move it forward?
Left and right.
And then that way.
Just give me 1 second. Okay, try now. Does it work? Okay, fantastic. Around here is yours. And now we have Alex Stuart for PSH.
Can you guys see me? Good evening, ladies and gentlemen. Let me introduce to you Pershing Square. Pershing Square is a closed-ended investment fund based in Guernsey. It has a market capitalization of £7.8 billion. It's listed on the London Stock Exchange under the ticker PSH, and 150,000 shares trade per day. So the share's quite liquid. There's no bid-ask spread. The fund is managed by Bill Ackman. He's a renowned value investor. He graduated from Harvard and then went to study his MBA at Harvard, graduated almost at the top of his class. So he's very smart and he has a lot of integrity. So to summarize, why am I investing in Pershing Square? So Pershing Square has an excellent track record. So since inception in 2004, they've returned 16.5% per annum after fees, which is exceptional. And this is compared to 10% for the S&P index. So although he charges a fee, it's worthwhile because even after fees, you're outperforming the index by 6.5%, which is a massive margin, especially if you compound it over time. So here's a graph of his results. As you can see, I've highlighted certain sections in yellow. So the average return is 16.5%, that's after fees, as compared to the S&P 500, which is benchmarked it against, which is 10%. So this fund is trading at a 20% net discount to net asset value. I think it's even more than that because the share's fallen in the last couple of days. And it's in my opinion that a fund like this should be trading at net asset value or even higher because of the outperformance. It's got high insider ownership, so Bill Ackman and his associates own 27% of the shares, and that's also increasing because they're buying back shares, and they're buying back shares at below net asset value, which increases returns. So they've bought back 26% of the shares outstanding. This is since 2014, and that's good for shareholders. It's also increasing their ownership. I like when the fund manager has all of his net worth in the fund alongside me, because then he really believes in the fund. So how does Bill Ackman achieve such high returns? So he's a value investor, but he's not deep value. So he buys businesses that are high quality, that have durable competitive advantages, and predictable cash flows. It's not something I do, but I can understand what he does. He's also a long-term investor, so he has a very long-term horizon. Most funds seem to be rather short-term and rather speculative. He's a value investor. He's basing his decisions on fundamentals in the long term. His portfolio also has low turnover. He pays little in broker fees, little in taxes. In 2023, last year, they bought Google and sold low, so they just made 2 transactions. There's some macro bets and stuff, but those are kind of minor. It's also a concentrated portfolio, so he doesn't overly diversify. Currently, I think there's about 11 or 12 investments in the portfolio. He does not dilute his best ideas with weaker ideas, and I think that contributes to returns. Because it's a small portfolio, it only requires a small team of analysts. They're all high quality, they're all the best. Well, that's an opinion of mine, but considering the returns over time, very, very high quality. Another factor that boosts his returns is he invests in the US, he understands the US, he understands politics, macroeconomics, and he only invests within his circle of competence. He's also an activist investor, so he can take substantial ownership in companies and then change the board and then improve the company, which boosts returns. The fund also has a very flexible mandate that uses a moderate amount of leverage. The debt to total capital is 15%. The bonds that Pershing Square issued, the average interest rate is 3.1% fixed rate, so it's not exposed to fluctuations in the interest rate. There's also no margin calls, and the bonds have an 8-year duration, so they're very long term. So if you can borrow at 3% and you can earn returns at 16%, you're going to boost returns for shareholders. He also, he's not always fully invested. He doesn't always have to be fully invested, and currently has 1.5 billion in cash, which can be used opportunistically to take advantage of a situation. To boost returns, Bill Ackman has bought several derivatives, which have turned out spectacularly. So during COVID, he bought credit default swaps. He spent 27 million buying the credit default swaps and turned it into 2.3 billion, and then used that 2.3 billion to buy during lockdown when markets were depressed, and the fund returned 70% after fees that year. They've made a statement in their most recent financial statements stating that portion of return is likely to increase, and they're kind of expanding their knowledge in the derivative side and making macro bets. So I've got a rough calculation here of the future performance that I expect for Pershing Square. So I've started with 16.5% as the base. which is its historical return. And I've added back the fees. Currently there's a 1.5% annual management fee, and then there's also a performance fee of 16%, and the high water mark is 0. So the fees are quite substantial, but it's outperformed over time. If you look at the performance before fees, is 20% versus the market of 10%, so it's outperformed by 10% each year over 20 years. So I've made several adjustments here. I've said that it's easier to make high returns on smaller amounts of capital. So when the fund first started, it had $500 million under management. It now has 12 billion, and there's also a new fund being launched in the United States. So for that reason, I've made a significant downward adjustment, and I've reduced returns by 4%. It's much harder to make those kinds of returns with larger amounts of capital. I've also said that the US market is overvalued, and since the entire fund is invested in the US, I've made another significant adjustment. I've reduced returns by 3%. I've got 3 main indicators that show the market overvalued. So I've got the Buffett indicator, I've got the Schriller PE ratio. I was going to include them, but it's meant to be a 20-minute presentation. And then I've also got the inverted yield curve. So those are the negatives. I've also got a few positives, which I think will increase returns in the future. So there's a return to a core focus on investments. So it's a closed-ended fund. It's got a very stable capital base. Like before, he ran a hedge fund, and if the fund underperformed, he'd have redemptions at the worst time, and then he would have to sell a portion of the portfolio to get cash to pay out investors. So this gives him a structural advantage. I also like the fact that he's not shorting anymore. He shorted Herbalife. Carl Icahn got involved, pushed the share price much higher. Subsequently, Herbalife's fallen significantly, but shorting exposes Pershing Square to unlimited losses, and the shorts that he's made haven't really boosted returns. They may have detracted from returns, so I'm quite glad that he's not shorting anymore. There's also a new Spark structure, which allows the investment fund to buy private equity deals, and it basically expands the scope of what they can accept as a deal. So I've boosted returns there again by 1%. And then if they keep buying back shares at below net asset value, that's obviously going to improve returns for shareholders. So I've added all that together, and I've got 17.64%, and then I've deducted the fees. So there's a 1.5% management fee, and then there's also a performance fee, but that performance fee is being reduced because of the new fund that's being launched in the United States. So if the new fund in the United States is able to get $25 billion under management, then the performance fee I've worked out should be 40% less if returns are about 15%. So if the performance fee is less, I'm expecting it to trade closer to net asset value, because I'm thinking that's the reason why it's trading below net asset value. So there's some additional benefits to buying Pershing Square. You can buy US companies without having to pay a foreign exchange fee if you're buying a London stock. You are also entitled to a 1% dividend. I prefer not to have a dividend. I prefer that you reinvested the money, but if you're a dividend yielding investor, it does give you some sort of return. And over this, I think the last 10 years has really suited growth investors, and he's been a value investor, and I'm thinking that in the next recession, he's going to be able to take advantage of some more deep value opportunities. So he's performed 20% during a time when value underperformed. I'd just like to say there's a disclaimer, it's not a good idea to buy the shares individually. Each position is publicly disclosed. Although you're not paying a fee, you're not paying the fixed fee and the performance fee. You won't know about his trades until after they're disclosed. So if he's bought a new stock, you'll be buying it slightly higher because he's been buying it, and if he sold a stock, you'll be selling it probably at a slightly lower price because he's been selling it, and you won't also be able to take part in the derivative trades because ordinary retail investors like you and I can't buy credit default swaps. It's just outside our scope. So there's a few risks, as there is with any investment. One is key man risk. So Bill Ackman manages the fund, but he's 56 years old. He's got a long run ahead of him. He's in good health, and I'm thinking he's going to stay on like Buffett. There's also a team behind him. There's established processes. There's a culture. So should he retire earlier, there's still a high quality team behind him. I think returns will be slightly less if he's not part of the fund, but I don't think it'll be too much less. The volatility of the fund performance, it's not a passive fund, doesn't really track the index. But if you look at, if I go back, the largest loss that it's made is 20.5%. You can see it there in yellow, as compared to the S&P, which made a loss of 37%. So, in my opinion, it's maybe slightly less volatile than the S&P index. So some people are saying that Pershing Square is a riskier portfolio, and therefore it should trade at a discount to net asset value, but I don't agree with that. Generally, the companies in the portfolio are well-known brands, they have strong franchises, they have stable cash flows, they're not highly levered, and they're exceptionally managed. I would say buying at a steep discount to intrinsic value can reduce risk and also increase return. There's a myth that you have to take on a lot of risk to achieve a lot of return. Sometimes you can have an investment that's very low risk and very high return. Some people are concerned with the concentration of the investments, but once you have 10 investments, you're about 80% diversified. If that's not diversified enough for you, then you can just make this a portion of your portfolio, so maybe 25% of your portfolio. It's my opinion that high conviction bets backed by in-depth research reduces risk. I also feel that concentration, where you weight your most undervalued investments, is likely to boost returns and also reduce risk. The fund also engages in hedges, that it bets against certain events that could impact the portfolio, so it has less systemic risk than an ordinary index. And the excess return above the S&P serves as the margin of safety. So as you can see, before fees, Pershing Square has outperformed by 10% a year. So if it doesn't achieve what it has in the past, but let's say it's 5% less, it's still outperforming the index. So that's the margin of safety. I'd say that it's statistically impossible to outperform over such an extended period of time by such a large margin. This fund has 20 years of a track record, and it's outperformed before fees by more than 10%. And there's also a history of other funds that have a similar philosophy, outperforming. So this isn't luck, and it's not a fluke. This is skill, and this is patience, and it's understanding and approaching investments in the right way.
It's not Cathy Wood.
Yeah. There's another risk is that he's quite active on Twitter. He has controversial opinions. I agree with most of his opinions. And this may scare some investors, but I also think that he's becoming more popular, and there may be a counterbalancing demand for his shares because he's becoming more well known. You know, if he annoys the wrong types of people, Pershing Square and his associated companies may be investigated. They may face lawfare or difficulties, so that's also another risk. Since the fund is 100% invested in the US, I have to talk about macroeconomics and politics. I'm a bit concerned about the US. I don't think it's a stable country it used to be. It's very unequal, and that creates a lot of tension. A big difference between those, the haves and the have-nots, or the haves and the have-nots. There's an eroding middle class, there's escalating debt levels, and there's the long-term conclusion of the debt cycle, which is evidenced in Ray Dalio's book. Currently, debt is 35 trillion, and I just can't see how they're going to pay that back. And the debt to GDP ratio is 135%, which is very high. There's also an erosion of shared values. I feel like the United States has promoted diversity, but it hasn't really promoted unity. I feel there's not much holding the country together, and it's very polarized. And the Republicans and the Democrats hate each other, and this is all a concern for me. There's also been ethnic and religious conflict in the United States. I think Black Lives Matter, and then there's also been contested elections, I think January the 6th. So those are the risks, but I think it's still a worthwhile investment, and I intend to hold it for a long period of time. So to conclude, if I hold Pershing Square for 20 years and it compounds at 15%, and then it trades at net asset value, that's a 20 bagger in 20 years. So that's a great investment for my pension, and I think it's low risk over an extended period of time. So I'm not buying this company because it's trading at a discount, although that's an additional benefit. I'm buying Pershing Square because of its long-term compounding track record that I expect to continue. This is within my circle of competence. I understand what he does to a large extent, and it's an investment that's kind of easy for me, that I feel comfortable with, and all I have to do is just be patient and just wait.
Now we will take 3, 4, 5 questions for Alex, and then all speakers will go up.
Ask one question at a time, not like 4 questions in one question. It's a bit hard for me.
Thank you. That's a good presentation. I had a question. Do we have any foresight of how the new fund is different to the current fund, and is there a philosophy difference, or what's going on?
So the fund will be a mirror image of this fund. It'll be invested in exactly the same manner, but it will charge a 2% annual management fee and no performance fee. So there's a higher annual management fee, but there's no performance fee. And the larger the fund, the more the reduction in the performance fee for Pershing Square based in the United Kingdom. So it'll be invested in exactly the same way. It's not going to be materially different.
Thanks, Alex, for your presentation. Are you able to talk a bit more? I know you mentioned you've got a Keyman risk there with Bill Ackman, and I know you mentioned they've got great analysts and culture, but is there anyone in the firm where they're going to, Bill Ackman is planning succession planning, in other words, because is anyone willing to step up? Because I fully appreciate it's not just him researching the investment, etc., but he is the key player. He's the one who's obviously making those decisions. And have you looked at the underlying businesses, for example, on Data Roma, in regards to what Bill Ackman holds in the companies? Because ideally, even though he's making the investments, it's those businesses that are going to bring the returns. So maybe just a few words around.
So there is a team behind him. Ryan Israel's one of them. I'm not sure who's going to be his successor. I feel like he's too young for that to be a consideration. If he was Buffett, then it would be something that he should obviously do. With regard to the portfolio composition, I know what he holds, but I haven't done the deep dive, the research that's necessary, because some of it's outside my circle of competence, and he doesn't publish the in-depth research. He just gives like a short summary in his financial statements, and I've read all of those, but it doesn't include discounted cash flows or anything detailed. But I do know that the businesses that he does own are, it's like restaurants and, maybe a hotel and maybe a railroad and Google, and it's things that I feel is within his circle of competence, things that even I could understand. But I haven't done a research report on each particular company. I just don't have the time to do that.
Domino Pizza is one.
Yeah.
I remember he said that.
Yeah, Burger King. Yeah. Anyone else want to?
Just a great presentation, Alan. Thank you. Very quickly on shorting, you said you're pleased that he's not shorting anymore. Has he made any comments about not wanting to short ever again in the future? Because that sounds like it's a concern for you. Or, you know. Do you know if he's going to do it again? I mean, you could get into a same situation.
I mean, he did publicly state that he's, and it's also in his annual report that he's not going to short anymore. I mean, he may change his mind. I mean, maybe, you know, markets become exceedingly overvalued. You know, maybe it might be a good thing. But I think he'd rather just buy an option, put option on something, than short. It
doesn't concern you that looking forward?
Well, I think it's a good thing that he's not shorting. He got into a bit of a mess with Paycom. I think his analysis was correct and has proved to be correct now, but he had to exit the position at a loss. So I think Herbalife's down 80% from the price that he exited, but he just couldn't handle. He couldn't handle the volatility of the share price. And there's also, you know, if you're an important, powerful person, you have enemies, and maybe they want to get back at you or get even with you, which is what Paycom did. So it's more complicated than, you know, just what's the intrinsic value and what's it trading at. There's additional factors that have to be considered when shorting. I mean, it also exposes the fund to unlimited losses, which is a big risk.
So, quick question here. How much they are raising in this new fund?
Well, I think it's estimated to be about 25 billion. So it's 25 billion plus 12 billion. So the two funds will be 37 billion. It's large. It's a large raising. It's like the perfect time to raise capital because the market in the US is overvalued. I prefer that he didn't do it, to be honest, because I prefer a much smaller fund. I think it gives him more opportunities. But it also means that the performance fee will fall significantly by about 40%, and I'm thinking it's going to trade close to net asset value because of that. And also like 37 billion, there's still a large scope of investments you can buy with that kind of capital. You might, maybe it won't just be as concentrated. Maybe instead of 10 investments, maybe you'll have 13 or 15 or so.
Are you sure they're going to replicate this first fund and the second one?
Yeah, it's been stated that it'll be the same strategy, same everything. It's just.
So essentially, if you raise the second fund, you're going to bid up all the stocks from the first fund.
Well, I haven't thought about that. I don't think so. I'm not sure. I'm not sure exactly what's going to happen.
I mean, I'm just
yeah.
It can get you NAV really cool, really fast once they raise the second fund because they're going to build up like Chipotle, Domino's, all those stocks, $25 billion.
I would assume that they're going to increase positions. Maybe they will also find new positions. So probably a combination of both. Some of it may be just left in cash for a while because the market's overvalued. I mean, like some of the stocks are not big enough that you could just put billions more into it. So it just doesn't make sense.
This is just a curious one because I know you're a poker player. How do you read Bill Ackman? Because obviously his track record is exceptional and there's no question about his skill. Totally agree on that. But Bill Ackman is Bill Ackman. And when you buy his funds, you also need to deal with his personality, which at times can sort of look a bit Elon Musk-y. He just can't help it, can he? It's sort of when you get someone a briefcase of money, do you want that energy in your life? How do you deal with that? Yeah.
I mean, I might see him for an investor conference once a year. I might attend the annual general meeting, but to me, like his personalities doesn't really make a difference. As long as the returns are high, I'm quite happy. is it's a free country, and he's able to express himself however he wants. And you know, I might not agree with everything he says, but I don't agree with everything. You know, most people say so. I quite like Balakan, so I mean, I don't really have an issue with them.
So now we can also have the other two speakers, and you can speak the questions among the three. Again, a big round of applause for Alex. You can come up as well. So just try to keep it even. Yeah, you can all stay around there so the camera can catch you. No. I can do that. Yeah.
Can we shorten Narcos and go long POF?
Okay. So
just joking.
Right, just try to split the questions among the three. So next one. No questions. They were all for Alex. Like, do you have any questions? General questions?
Or questions that they are for all three speakers. Might be for their strategy, their selling point. Yeah, go.
I just got one for you for the software company. Have you looked at any metrics around how long does a client stick to a certain provider before they switch over to someone else? Do you have any views on that?
Yeah, basically 2 points. In terms of retention rate and overall stickiness, it's really very sticky business, so it's 90% plus. It was even higher before, like 95% retention rate, and it's not specific to Paycom, it's like overall industry. Let's say ADP still enjoys like 90% retention rates, so it's really sticky business, and companies are generally hesitant to change their payroll providers. So it's a big plus for the industry that they have this stickiness based on payroll part, and they can cross-sell HCM solutions that are not that sticky actually, but they come on top of it. So it's quite a sticky business. However, I would add that in case of Paycom, they do not sign long-term contracts with clients. So usually it's 1 year contract. Again, it's quite telling that they basically rely on this stickiness and on their quality and value they provide to the client. But again, in some parts of enterprise application software, we have multi-year contracts, at least like 3 to 5 years. So yeah, this is also a consideration.
Just sticking to, and great presentations to all, but just sticking on the software theme, I heard this thesis that with a lot of AI, in the next decade, hardware stocks will outperform software stocks. Of course, that's broadly the theme, but do you think in the application software market per se, you'll see some kind of P's dropping or valuations dropping just with the whole AI trend?
So, in my opinion, we to some extent have already seen this comparing to like 22 and 23. It was slower growth, it was moderation in valuations in some parts of software market already. However, other part is still like sky high. Let's say, I think today or yesterday we had earnings from ServiceNow. We had partnership between Salesforce and ServiceNow. I think so. I think valuations are not that high in part of the market, like payroll companies is an example. In terms of AI and its impact on software industry and payroll companies, it's actually big question. I think it can be a huge impact, but companies that are innovating, that are already trying like new ways, like let's say Paycom is at least trying this to its own detriment to some extent. So I think they are better positioned to integrate AI. However, I think long term, let's say like 5 to 10 years, if AI is really big thing, again, like ServiceNow is trying to integrate AI into like the whole enterprise, different parts, and HR, finance, business, and so on. So I think it's a risk that at some point they can come to like payrolls as well. It doesn't seem like unbreakable in terms of like complexity of it. So yeah, I think to be relevant, at least payroll companies should be mindful of integrating AI into their solutions, and yeah, probably even to expand further outside of payroll to like some enterprise solutions into business like ServiceNow, like yeah, but actually I think in terms of valuations, this part of the market, payrolls and HCM, it's quite moderate valuations, like 20 to 30. So yeah.
Okay, yeah.
This is more of a general question. When you guys do your investment research pieces, sometimes I feel like we can be quite biased and look for favorable information when we invest in these companies or our thesis. How do you destroy your best ideas in regards to look for information to actually go against what you're researching? How do you approach that?
You have to read the financials, obviously the whole thing, and look at the risk section. That's important. And then also, I think most important is having a good network of intelligent people around you. Pass them some research to say, put holes in this. Like, where could I be wrong? So maybe, to kind of, maybe I can't notice my own biases, I need someone else to point them out to me. But if you've got, 4 or 5 people that can look at something and they have, a kind of respectful but intelligent viewpoint, it kind of helps, and then you can add that point to your thesis. And sometimes there's an emotional bias. I mean, I've been wrong on a few investments. I bought a fraud in China, and I just didn't want to change my mind because I'd written a long research report on it. And I was even saying, well, there's more cash in the bank than the market cap. How could they fake the bank records? So it's difficult. So you have to also be aware of your emotional state when making a decision. So it might just be a good idea to go for a walk or do a meditation, or get yourself calm and get yourself in the right frame of mind to make a kind of compassionate, rational decision.
Okay, so my way is I come and present to people, and then I get abuse on traffic. I think what's interesting is to try to read bears on the stock. It's true, it's hard to find analysis. And what's really important, I think, is going beyond just reading the annual report and thinking what can be the risks. So in the risk, they weren't going to say Donald Trump is going to put 20% duty, but you need to try to think what can go wrong, and what's the worst case scenario, and are you protected? But I agree with you, it's really hard. So also when we present, don't want to be wrong, so we promote a bit.
Yeah, I also want to emphasize that it's really tough, especially when you source your idea. Basically, if I decide to dive into some idea, I already know why. I already know that it's like quality or value of both, and good valuation. So I would say I'm very attentive to negatives. If I see, for example, that, let's say, Chad Richardson was highest paid CEO in corporate America like 3 years ago, I should come up with some like believable explanation that this is not the case right now, it's not going to screw up shareholders and stuff. So I place even more emphasis on some negative pieces of information, because I think they are much more actually useful, because if I have this view on quality and valuation, I think it's good, but like in a way, even very good investment or potential investment is controversial because you're not going to have good value and quality and what have you. So that's why I try to put like to be like not only cautious and conservative in my assumptions, but also to put like extra emphasis on any negative pieces of information I found out about the company, and if I couldn't find like some durable explanation which is like reasonable for me in regard to these negatives, probably I have not been searching enough, and it's actually not that predictable.
Just I think that is really good if you want. You try to have a checklist, and if there is one or two things that just don't work well, even if it's very, very, very sexy, you know, red flags, I'm not going for it.
And also some okay.
Questions for David on Technoglass. Two really. The first one you said about hurricanes, tornadoes in Florida, and so on being a good repeat kind of business for them. Do you know what percentage is repair versus new expanding construction? Because over a period of time you could get quite a nice return from the fact that we might have more weather effects, for example. And the second question is, have you looked at how any of their other competitors might have successfully applied this model of expansion? Because if you're looking at different states, maybe in some states, local builders might have good relationships with existing companies, and then you're dealing with trying to break into these new markets. Has anyone else managed to expand in the same way? So those are my questions. Thanks.
Okay, so for the first one, so as a CFO, it was an interview, but it wasn't like an earning course. We did say that around 60% was repair and remodel, something like that. I guess when there is booms in terms of housing, they're doing better, but still have this margin of security. And what is quite unique is that they manufacture in Colombia. They get cheaper prices and they have the entire value chain. It was one of those slides where it was, probably you didn't see it, but it was comparing return on equity and return on capital invested from Technoglass with building companies, building products companies in the US, and they were 2 or 3 times higher. And I think that speaks volume. So yeah, I'm sure someone can replicate it in a way, but good luck.
This is a question for all three of you. It's more about not the stocks you actually picked, but more about how this fits within your portfolio. So I'm really curious about the sizing of the bets you take on, like that you already briefly said it, maybe it's 5%, but not just position sizing, but perhaps also like could you describe how this compares to everything else you hold? Like are all the bets you make quite similar? Do you try and diversify across sectors, that sort of thing?
You, Karen, I was about to ask something.
Yeah, so the Pershing Square is about 25% of my portfolio. It's a bit, well, I mean, I'm quite a concentrated investor, so I don't really believe too much in diversification. I think I kind of agree with Bill. I think once you've got 5, 10 investments, you're fine. I've made it, I think for the average investor, you could make it a larger percentage as compared to just an ordinary stock, because you're not buying a stock, you're buying a fund, and that fund contains 10 stocks. So you could maybe make this, a multiple of what your weighting would be for an ordinary stock.
So, okay, that was for everyone. Sorry for this.
Yeah, my position in Paycom is much less concentrated. It's about probably 3%. Again, it was, I acquired it at much lower levels, about 140, so it gone up already like almost 20% over the last months, but it was 49, so-called, at the time. So, yeah, in terms of how it fits into the overall portfolio, yeah, it fits into software part, like high quality, but with some temporary headwinds issues. So yeah.
Okay, my lines are generally between 5 and 10%. So this one has risk, so it will be more 5. I do try to have stocks that are not correlated. So it's really good to have, I don't know, 10 stock. If they're all in AI, they all drop at the same time. This is why I think this one was more interesting. Now the way I enter into it, I try to do trenches. And that was my problem was this one. So I wanted to put 5%, and it shoots up, and now I'm waiting.
We'll get the last one, and we will keep the answers. Let's keep the answers short because we are running out of time.
Are you guys reading any book currently at the moment that you find really interesting?
That's a good one. Thanks.
So I've just finished Quality Investing by Cunningham. It was written in with actually by AQ Capital portfolio managers on quality investing with some examples. Quite a good well-structured book, so I would recommend it. Elon Musk biography by Isaacson, also a good one. I like it better than his previous biography 10 years ago. And third one, probably a bit controversial, it's The Fund on Bridgewater and Ray Dalio. So it's actually quite a fascinating book. Ray Dalio declined to be interviewed for this book, but it provides some insights into his fund. I mean, how his he was trying to rate people constantly, and it's quite a controversial book, so interesting read as well.
I think it's quite important to read biographies or autobiographies. I really like The Life of Rockefeller, J.D. Rockefeller. It's an amazing book. I also like, I think I need to understand more about the macro. So Ray Dalio, he's written a number of books. There's some that are more technical than others, but they're also easy to read, easy to understand, quite useful. And then I've also been reading quite a few poker books because I'm playing quite a few cash games, so I just want to get better. Yeah.
Okay, so lately I've been reading a book from a guy called Compounding Quality. I don't know if anyone follows him. Yeah, he's starting to be quite big. So he wrote a book, it's a really good book about quality. And it's quite cheap and so on. I'm also selling his book anyway. And there is another book, I don't remember the name, it's also about quality, and it's written by a firm called Red Eye, which is funds in Scandinavia. They have a podcast as well, okay, great. And it's very interesting, so it's very thick. It goes into a lot of detail about quality. There is give or take, you can't do everything they say you will do because it would take you 100 years to analyze one stock. But it gives you good ideas. So for example, I picked from that you want secular growth in any stock you buy. And now it's part of my checklist.
Okay. So thank you everyone. A big round of applause for everyone, all the speakers, they were great. Thank you. And for the audience, the nice audience. So we will close now, and we can mingle so that we can have some time to mingle and meet and talk. Thank you again. It's a great pleasure having you all here, and thank you for attending online as well. Bye.